Look, I need you to understand something that most people won't figure out until it's too late. We're watching history repeat itself in real time, and the window to act is closing faster than anyone realizes. Right now, gold just shattered through $3,400 per ounce. Silver's climbing past levels we haven't seen in over a decade. And if you think this is just another market rally, you're missing what's actually happening behind the scenes. Central banks are buying gold at a pace we've never witnessed before. For the third consecutive year, they've purchased over 1,000 tons. Think about that. These are the same institutions that spent decades telling us gold was a barbaric relic, that it had no place in modern finance. Now they're accumulating it like their survival depends on it. Because it does. Let me paint you a picture of what's unfolding. In the 1970s, we saw something similar. Nixon closed the gold window, severed the dollar's tie to gold, and what followed was a decade of monetary chaos. Gold went from $35 an ounce to $850. That's a 2,400% increase. People who understood what was happening positioned themselves early. Those who waited, who thought they had time, watched their purchasing power evaporate. We're in that same moment right now. Except this time, the stakes are exponentially higher. The World Bank just released data showing gold, silver, and platinum prices surging to record highs amid what they're calling global tensions and economic uncertainty. But that's corporate speak for something much more serious. What they're really saying is that the financial system as we know it is under stress, unlike anything we've seen since the 2008 crisis, actually worse than 2008. Here's what keeps me up at night. JP Morgan's global research team keeps raising their gold price forecasts. Every quarter, they revise upward. They're now projecting continued gains through 2026 and beyond. When the largest banks in the world are telling their wealthiest clients to get into gold, that should tell you something. But let's dig deeper into why this is happening now, and why the next few days matter more than you think. The dollar's dominance is being challenged in ways that would have been unthinkable just 5 years ago. The BRICS nations aren't just talking about alternatives anymore. They're building them. Trade settlements in yuan, rubles, and gold-backed instruments are accelerating. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting payment for oil in currencies other than dollars. This isn't theory. This is happening right now. When the petrodollar system was established, it created artificial demand for US dollars. Every country needed dollars to buy oil. That demand allowed us to print money with fewer consequences than any other nation in history. But that privilege is ending. And when it does, all those dollars that have been circulating globally are going to come home. That's trillions of dollars flooding back into the US economy. You know what that causes? Inflation that makes recent years look tame by comparison. Smart money sees this coming. That's why institutional investors are piling into precious metals at record levels. Western ETF investment in gold has returned after years of outflows. These aren't retail investors panic buying. These are sophisticated institutions with teams of analysts, access to data most people never see, and they're moving billions into gold and silver. Let me tell you about something most people don't understand about the silver market specifically. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. Every smartphone, every solar panel, every electric vehicle requires silver. The industrial demand alone is staggering. But here's the kicker. Above-ground silver inventories are at multi-decade lows. We're using more silver than we're mining. The deficit is growing every year. And unlike gold, most silver gets consumed in industrial applications. It doesn't get recycled. It's gone. So you have this situation where industrial demand is exploding, investment demand is surging, and supply is constrained. The COMEX silver inventories have been dropping steadily. At some point, and I believe we're approaching it rapidly, there won't be enough physical silver to meet demand at current prices. What happens then? The price has to rise, dramatically. Now, I want to share something with you that might be relevant to your situation. If you're sitting on retirement accounts worth $100,000 or more, there's a strategy that more people are using to protect that wealth. It's called a gold IRA, and it allows you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a comprehensive guide on how this works. It's completely free, and you'll find it in the description below. It covers the mechanics, the benefits, and the potential pitfalls to avoid. If you're concerned about protecting your retirement savings from what's coming, it's worth a look. But let me get back to why timing matters so much right now. We're seeing a convergence of factors that rarely align all at once. Geopolitical tensions are escalating. The Middle East remains volatile. Ukraine continues. Taiwan tensions are simmering. Each of these situations has the potential to trigger a flight to safety that sends precious metals soaring overnight. The Federal Reserve is in an impossible position. They need to keep interest rates high enough to combat inflation, but the government's debt service costs are becoming unsustainable. We're now spending more on interest payments than we spend on defense. Let that sink in. The largest military in the world, and we're spending more just to service our debt. Something has to give. And when it does, the Fed will have no choice but to pivot back to money printing. They'll call it quantitative easing or some other technical term, but it's the same thing. More dollars chasing the same amount of goods. That's inflation. And that's rocket fuel for gold and silver prices. Here's a historical parallel that should terrify anyone paying attention. In 1980, gold hit $850 an ounce. Adjusted for real inflation, not the manipulated CPI numbers, but actual purchasing power, that's equivalent to over $10,000 in today's dollars. We're at $3,400 now. If we see a similar crisis-driven rally, we're not even halfway there yet. But here's what's different this time. In 1980, the U.S. was still a creditor nation. We had manufacturing, we had savings. Today, we're the world's largest debtor. We've offshored our manufacturing base. Personal savings rates are near historic lows. We're in a much weaker position to weather a monetary crisis. The commercial banks know this. That's why their positioning in the futures markets has shifted dramatically. For years, they were net short gold and silver, betting on price declines. Now, they're reducing those short positions at the fastest pace on record. Some are even going net long. These are the same institutions that have inside information, that understand market mechanics better than anyone. When they flip their positioning this dramatically, you need to pay attention. Let me tell you about the paper versus physical market, because this is crucial to understanding what's coming. The COMEX and LBMA trade massive amounts of gold and silver on paper. Futures contracts, options, derivatives. For every ounce of physical metal, there are hundreds of ounces of paper claims. This works fine as long as everyone's content to trade paper. But what happens when people start demanding physical delivery? We've already seen stress in this system. There have been moments where the spread between paper prices and physical prices widened significantly. Premiums on physical coins and bars spiked. Delivery delays extended. These are warning signs that the paper market is becoming unstable. If we hit a point where confidence in paper claims breaks down, where investors demand physical metal en masse, the price discovery mechanism will shift entirely to the physical market. And there simply isn't enough physical metal available at current prices to satisfy that demand. The price would have to rise until demand and supply balance. We're talking about potential moves that would make recent gains look like a warm-up. Now let's talk about what's happening in the mining sector, because this tells you a lot about where prices are headed. Gold and silver mining companies are struggling to increase production. The easy deposits have been mined. New discoveries are rare. The ore grades are declining, meaning they have to process more rock to get the same amount of metal. Costs are rising due to energy prices, labor, and regulatory requirements. What does this mean? It means that even if prices rise significantly, supply won't increase quickly. It takes years, sometimes a decade or more, to bring a new mine online. The supply response is slow, but demand can shift overnight. That's a recipe for explosive price moves. I want you to think about your own situation for a moment. How much of your wealth is denominated in dollars? Your bank account, your retirement accounts, your investments. If the dollar loses purchasing power, all of that loses value in real terms. You might have the same number of dollars, but they buy less. Your standard of living declines even though your account balance looks the same. This is the insidious nature of inflation. It's a hidden tax that most people don't understand until it's too late. And the people who get hurt the worst are those who did everything right. They saved money. They were responsible. They trusted the system. And then they watched their purchasing power evaporate because they held their wealth in a currency that was being systematically devalued. Precious metals are the antidote to this. They're real assets with intrinsic value. They can't be printed. They can't be created out of thin air. Throughout human history, across every civilization, gold and silver have maintained their purchasing power. An ounce of gold today buys roughly the same amount of goods it did a century ago. Can you say that about any paper currency? Let me share a story that illustrates this perfectly. In Weimar Germany, during the hyperinflation of the 1920s, people who held paper marks saw their life savings become worthless, literally worthless. People were using banknotes as wallpaper because it was cheaper than buying actual wallpaper. But those who had converted their wealth to gold before the crisis? They preserved their purchasing power. They could still buy property, food, and goods while everyone around them was being wiped out. We're not in Weimar Germany. I'm not predicting hyperinflation tomorrow, but the dynamics that lead to currency crises are present. Massive debt, political dysfunction, loss of confidence in institutions, geopolitical instability. These are the ingredients. And once the process starts, it accelerates faster than anyone expects. The thing about financial crises is that they happen gradually, then suddenly. For months or years, warning signs accumulate. Experts point them out. Most people ignore them because life continues normally. Then, one day, something breaks. A bank fails, a country defaults, a major institution collapses, and suddenly everyone realizes the danger at the same time. That's when panic sets in. That's when prices move violently. We're in the gradually phase right now. The warning signs are everywhere if you know where to look. Record central bank buying, surging investment demand, supply deficits, geopolitical tensions, unsustainable debt levels, currency debasement. These aren't conspiracy theories. These are facts reported by mainstream financial institutions. The question is, will you act during the gradually phase when you still have time and options? Or will you wait until the suddenly phase when everyone's trying to get through the same door at once? Here's what I know from studying market history. The people who preserve and grow wealth during crises are those who position themselves before the crowd realizes what's happening. They're not smarter. They're not luckier. They just paid attention to the signals and acted while others hesitated. Right now, you can still buy gold and silver at prices that, in hindsight, will look like bargains. Premiums on physical metal are still reasonable. Delivery times are manageable. The market is functioning normally, but that can change quickly. When demand surges, premiums spike. Delivery delays extend to months. Some dealers run out of inventory entirely. I've seen it happen before, and it will happen again. Think about what happened during the 2008 financial crisis. In the immediate aftermath, try finding physical silver coins. Dealers were sold out. Premiums doubled or tripled. People who wanted to buy couldn't. The metal simply wasn't available at any reasonable price. Those who already owned it were protected. Those who waited were out of luck. We're potentially facing something much larger than 2008. That was primarily a banking crisis. What's developing now involves the entire monetary system, geopolitical realignment, and a crisis of confidence in fiat currencies themselves. The scale is different. The implications are more profound. I want to address something that stops a lot of people from acting. They think they've missed the move. Gold's at all-time highs. Silver's rallied significantly. They assume it's too late. But here's what they don't understand. In a real monetary crisis, the gains we've seen so far are just the beginning. We're talking about a potential revaluation of precious metals relative to fiat currencies. Not a 20% move or even a 100% move. We're talking about multiples of current prices. Look at what happened in the 1970s again. Gold didn't just go up steadily. It had multiple legs. It would rally, consolidate, then rally again even higher. People who bought at $200 thought they'd missed it. Then it went to $400. People who bought at $400 thought they'd missed it. Then it went to $850. The point is, in a bull market driven by fundamental monetary problems, the moves are larger and last longer than anyone expects. And we're dealing with monetary problems today that dwarf anything from the 1970s. The debt is larger. The imbalances are greater. The geopolitical situation is more complex. If anything, the potential for precious metals to rise is even greater now than it was then. Let me tell you what the smart money is doing right now. They're not trying to time the perfect entry. They're not waiting for a pullback. They're accumulating positions systematically. They understand that in the grand scheme of what's coming, whether they bought at $3,200 or $3,400 won't matter. What matters is that they're positioned before the real move begins. This is about wealth preservation first and profit second. If you own gold and silver and the crisis doesn't materialize, you still own valuable assets that have maintained their worth for thousands of years. You haven't lost anything. But if the crisis does materialize and you're not positioned, you could lose everything. The risk-reward is asymmetric. The downside of owning precious metals is minimal. The downside of not owning them could be catastrophic. I want you to think about your family, your future, your retirement. What happens if the dollar loses half its purchasing power over the next few years? What happens to your standard of living? What happens to your plans? This isn't fear-mongering. This is risk assessment. And the prudent thing to do when you identify a significant risk is to take steps to protect yourself. The beautiful thing about gold and silver is that they're insurance that can appreciate. Most insurance costs you money with no return. You pay premiums and hope you never need it. But precious metals can protect you from monetary crisis while potentially generating significant returns. It's the rare asset that serves both purposes. Now, I need to be clear about something. I'm not telling you to put everything into gold and silver. That would be irresponsible. What I'm saying is that if you have zero exposure to precious metals right now, you're taking on more risk than you probably realize. A meaningful allocation, whether that's 10%, 20%, or more depending on your situation, makes sense as a hedge against what's developing. The central banks understand this. That's why they're buying. The wealthiest families in the world understand this. That's why they've held gold for generations. The question is, do you understand it? And more importantly, will you act on that understanding? We're at a pivotal moment. The next few days, weeks, and months will determine who preserves their wealth and who watches it evaporate. History is giving us a clear signal. The same patterns that preceded every major monetary crisis are present right now. The same warning signs are flashing. The same flight to safety is beginning. You have a choice to make. You can dismiss this as just another market fluctuation, another false alarm. You can tell yourself that the system will hold together, that the authorities have everything under control, that it's different this time. Or you can look at the evidence objectively, recognize the risks, and take action to protect yourself and your family. The window is open right now, but it won't stay open forever. When the crisis accelerates, when the suddenly phase begins, it will be too late to position yourself effectively. The time to act is when you still have options, when the market is still functioning normally, when you can make rational decisions without panic. I've laid out the case. The central bank buying, the supply deficits, the geopolitical tensions, the monetary imbalances, the historical parallels. This isn't speculation. These are facts. The question is what you're going to do with this information. History is repeating itself. The patterns are clear. The outcome is predictable. The only variable is whether you'll be positioned on the right side of what's coming. You have days, maybe weeks, to make this decision while conditions are still favorable. After that, you'll be competing with everyone else who finally woke up to the reality of the situation. Don't be the person who looks back and says, I saw the warning signs. I knew what was happening, but I didn't act. Be the person who recognized the moment, understood the stakes, and took decisive action to protect what matters most. Your future self will thank you for the decision you make right now.